morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show, we'll be joined by our guest co-host, John Zechner, chair and founder of J. Zechner Associates. And later, our featured guest, Jamie Gollenbeck of CIBC Private Wealth, will dive into planning. And we want to hear from you this morning on First Call. Reach us with your questions on North American large cap stocks, and John will answer as many of them as he can. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes, and our email address, if you don't want to call, is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you here in the BNN. Shares of Lululemon are surging in pre-market trading. That after the Canadian apparel company posted profit and revenue in its latest quarter that topped estimates, driven by higher same-store sales and growth in international markets. Lulu also boosted its full-year revenue outlook and announced CEO Calvin McDonald is stepping down at the end of January. Some analysts see the move as positive, noting the company has been facing slowing sales. Costco is out. Wholesale giant logged higher profit and also saw total revenue jump more than 8%, beating estimates. Same-store sales across Canada, the U.S., and international markets also came in higher than expected. Costco says the results were helped by a record-breaking Black Friday for its U.S. e-commerce unit. Shares of Broadcom are under pressure in the pre-market. It's down more than 5%, almost 6%. It was down at 1.10%. Chip company beat on revenue and profit, but investors seem to be focusing on its AI backlog and margins. Broadcom's backlog of AI product orders was weaker than some analysts expected. The company also held off on giving an AI revenue forecast, warning that total margins were being impacted by AI product sales. And now our top line story. Lululemon is facing big changes. CEO Calvin McDonald has announced he's stepping down after a year of struggling sales. The company is searching for a leader to revive growth amid fierce competition and shifting fashion. Let's bring in our guest co-host, John Zechner, chair and founder of J. Zechner Associates. John, always a pleasure to have you.
Hey, Roger. Good to see you.
You getting some skiing in soon, right? We were just talking about that.
Probably be out later today.
Ontario. Okay, let's. Will you be wearing Lululemon though when you're out on the hill?
Yeah, I don't know. I mean, I'm not sure, probably in that category. I probably have the same stuff I've been wearing for the last 20 years.
So maybe you're part of the problem then.
I'm part of the problem.
For Lululemon, shares are up at one point. They were up at about 10% even. Is that all on the numbers, or is that on Calvin McDonald stepping down?
I think it's more on the numbers off the bat. Probably it's a combination of both. But the bar was set pretty low for Lulu. And when you look at it, I mean, it's a very nice pop this morning, but let's look at the longer term chart on that one. It's been they beat lowered expectations. It was, and they sort of no sort of worse guidance going forward. And clearly they have branding has been strong for them. They've continued on that. They're facing more competition, but that in that athletic wear area, they're still very dominant. So yeah, it's probably a good story. Valuation-wise, it's a lot more attractive than it was. And if they've started to turn their corner on margins, great. It's see what the new management does.
What do they look for a new CEO? Do they look from outside? Do they try and bring within, or do they need to go outside?
Well, I think you usually want to. It's hard to bring from within if the story hasn't been working for a while, because if you've been within, you've had some impact on that. So it's usually better to bring in someone from the outside, bring in new ideas, new changes, things like that. So those generally, particularly in retail, I think makes a lot more sense.
And within apparel, do you think, or would they go just even look for somebody?
I think it always makes sense to stick with people in the industry. Yeah, like, sometimes it's good to get a good CEO who just, understands business in general. But I tell you, in those businesses, you find, you've got to know the suppliers, you've got to have the contacts and the customers as well. So, yeah, you need experience in the industry, absolutely.
And what would they tackle first for them? What would you think the first focus would be?
Well, I guess you look across the board. What's your online presence? What's your store count? What's the profitability of the store? What are your same store sales? What are your margins? What are your, cost of input? Where are you sourcing your products from? Can you change that at all? Can you streamline that? Yeah, I think you go up and down the whole, realm of the company and all the possibilities, and just, the financing, that's maybe not as much of an issue here, but, retail's a tough business, and it's thinner margins in a lot of cases, and, sourcing of supplies is key. So it's, it's a lot of balls in the air, but that means a lot of potential areas where you can do some repair.
A gut job, or will they be able to kind of trim and tighten smaller areas?
Well, it's still a bit of a crapshoot, I hate to say it, from that point of view. I mean, trends change so quickly, taste changes, these sort of groups come out of nowhere. You look at Aritzia or Group Dynamite or something like that. These guys come up with incredibly hot numbers, and you've never really sort of seen them before. They hit style for a while, and then styles change quickly, and the teenagers and in that whole realm, that it's harder. It's not like. This is not like, Walmart or something like that, where you got a broad-based category and everything is your cost of goods sold and distribution and other things like that. You have to sort of hit something beyond that. It's almost like more like the, media companies or something like that. I mean, the right shows or the right movies or things like that. So.
And have you seen cases like this and they've turned it around, or the ones that have failed?
Oh, no, I've seen turnarounds that have worked. It's a bit of a coin toss. It's sort of, sometimes momentum is key in that business. Once you start to lose momentum, it's awfully hard to get it back, but it helps if you've already got a good brand. So that, in that case, that probably works to their advantage. Everyone knows them, and they've been a category killer for a period of time now. So,
any success stories come to mind? Put you on the spot for a second. That might be comparable?
In retail, I can think of more failures, quite honestly. Yeah, you caught me off guard with that one a little bit. And I started going through, no, there's nothing off the top of my head that.
How about failures then? Which ones, what did they do wrong?
You look at like over the years, the Dialex, the Bay, and all of those companies, they just, stumbled, and the industry changed more quickly than they could make adjustments to. And, a couple like Dialex, it goes back a couple of decades, Wolf Poslins and all of that. Yeah, they just, they were dominating with so many brands and so many different kinds of stores and all of that, and then taste change, and suddenly they lose it, and then it's you in a thin margin business, your cost structures, and it hurts you dramatically.
So what do people do with this then, the investors?
Oh, I think if you've been a shareholder for a while, you hang on and sort of give them a couple of quarters to see, and. Because, actually, when you say that now, too, about the change, you look at stuff like, Starbucks in the past year and all of that, some of those changes, Chipotle on the restaurant side. I thought, in those cases, sometimes the new blood sort of changes around, and you get an initial lift off of that. And, if you've sat around this long, you may as well sit around for another quarter or two and see if they can improve, especially given the valuation is, gives you a little more downside protection than it has in the past.
Okay, we'll leave it there for now. But coming up, we are starting to see some cracks in the AI trade, and is the boom losing steam? More on that next. All right, let's see how things are shaping up on the markets. We'll start with the U.S. futures. Broadcom, Oracle, their earnings reports weighing on the NASDAQ on the final day of a likely positive week. But you can see NASDAQ's off by a half point right now. Dow futures up 0.2, and the S&P off by 0.08. Turning to Asia now. Let's see how they finished the day. Lots of green there. Look at those numbers. The Nikkei up by 1.37, almost 1.4. Hang Seng up by 1 3/4. And the CSI 300 up by 0.63. Fresh records for the Dow. That Fed rate cut boosting risk appetite there, seeing that surge. Heading over to Europe. Banks and cyclicals are leading gains as markets look to be up for a third week in a row, and they're closing in on that. It'll be close for the FTSE. It's about a wash right now, but the CAC Caron up by 0.46%. The DAX up by 0.15. And the TSX, another record yesterday. Mining and resources driving it up to that record high close on Thursday, up by more than a half a point. Who were some of the movers? Let's take a look. maybe having some technical difficulties. There were some movers, though. Trust me on that. All right, taking a look at the metals. By rate cuts, strong safe haven demands, gold in near record territory, up over almost closing in on 4,400 right now, by 1.34%. Silver, though, what a drive it's having right now. It's up again by 0.3%, well into record territory. Copper as well, hovering around record territories, but it's slightly off. And taking a look at oil, you can see geopolitical concerns and like Venezuela, Russia, Ukraine, they're offsetting concerns about oversupply, but right now still down. WTI is off at 57.64. AI and big tech have driven markets to record highs, but the cracks are starting to show, from soaring valuations, mounting debt, and questions about magnetization. Should investors take caution heading into 2026? For more on this, we're back with our guest co-host, John Zechner, Jay Zechner and Associates. Let's talk Broadcom first, John. Your thoughts on what was said by the CEO and where they're going?
I guess Hawk Tan didn't really come out and give a lot of really good guidance, which is probably why the stock sold off. I mean, for all of these tech companies, the bar is set very high in terms of expectations. You saw that with NVIDIA, they blew through the numbers, raised expectations, the stock still sold off a little bit. So, I mean, this is a bit of a worry overall, the way some of these leadership stocks, sectors, for the past couple of years are starting to roll over a little bit. You're picking up gains and elsewhere in the market, but sometimes when leadership loses like that, it's a bit of a worrying sign overall. But on Broadcom specifically, I guess it was just a bit of a disappointment when he didn't talk about, the backlog. Wasn't as convinced on it. People was expecting another, something maybe more about OpenAI as being another contractor. We expected it was Google or Alphabet with the TPUs. Anthropic is clearly one of their clients as well. But and sort of their non-AI business is, it's not clicking along at the same rate. And then margins are a bit of worry. And my concern overall for the chip industry on that one as well, because in the old days, I mean, margins for Intel for years and years, I mean, you'd run 60, 65% at best. And you look at the last, year or two on the GPU market and all of that, because it's been such a tight supply and so few sellers that even running margins north of 80%, that's not sustainable. So, if we're coming down into the 70s now, if we go lower, and that's a problem, if sales slow down at the same time that margins come under pressure, then your EPS growth could almost disappear completely, which is a problem for, these very high multiple stocks. And Broadcom was trading at a 40+ forward multiple. That's, that's not chump change out there. And because I look at it right now, NVIDIA is probably looking like a safer bet in the whole sector because they're still dominant. And I think they're trading around 24 times forward earnings right now. So they're going to continue to dominate the GPU market. We know the spending's going to continue on the AI rollout, on the data
It feels
centers.
like they have no choice.
Yeah.
They've got to keep spending.
But there's something else going on here. I mean, is it the over-ownership? Is it the index weights? It's a passive indexing. People just have too much money in these things, and it's, they're starting to look elsewhere. Like, say, the expectations are high, and then obviously the other questions coming into tech in general. I mean, the financing. We saw the Oracle numbers the other day, Roger. What a disappointment. And then the questions: what's happening with the CDSs of Oracle and how they're financing outside? $90 billion of debt financing. Free cash flows have gone negative. The best story in technology for years was these, behemoths. So they're just generating massive free cash flows, and they're building up, these massive cash hoards on, Apple and everybody else. And suddenly you're on the other side of that. They're out there in the debt market borrowing to fund this AI growth for something that we don't know what the profitability is going to be yet. And I think that is the question overall that's probably hanging over the industry, as the biggest risk.
But has their debt borrowing been all that bad, though?
No, not to this point, but when you borrow and when the spreads widen, that's a negative sign. And if you have to keep going that road, because you're right, in the end, what they've raised in debt is not that significant compared, what their, cash balance has been, and what certainly compared to the market capitalizations. But it's just, when you can't fund it on your own anymore, and I mean, that's been the story of the, free cash flow generation, and you can use that to, buy, expand, you buy other applications, whatever. If that story dries up a little bit and you're negative free cash flow, that's a problem.
Now, what do investors want? What do they want to see, do you think, in the next year? And is it realistic on what, especially the Mag 7, what they can deliver the tech?
I think they really have to see some honest monetization of the move to AI. Like, it's one thing to talk about it, but I look at something like at OpenAI the other day, like ChatGPT, 800 million users that they talk about, okay? But you got 10 million paying users.
Yeah.
So we're almost back to that eyeballs argument that sort of blew the top in 2000. And I thought, okay, you got to get people paying for this at point. It's free service one, but on the other hand, you got to deliver it. So, and I think the guys who are best able to do that and consolidate it and sort of charge a fee for it, or I still think the hyperscalers, because they can roll it in. The ChatGPT is part of it, but Gemini for Alphabet and others. So I think that they can do it best, and plus they can monetize it by wrapping it together, on their public cloud or their applications as well, and get it down to the customers. But you have to start to see it. You have to see it in productivity gains. You have to see it in cost cutting. Whether it's healthcare, telecom sectors. People have to see that these, multiple hundreds of billions of dollars or even trillions of dollars, you have to have a return on equity, a return on investment. And it has to be pretty massive.
All right, we'll wrap it up there for now, but we've got lots coming up with John. It seems more Canadian companies are either holding or cutting their dividends. We'll dive into how investors should respond after this. Dividend strategies are shifting across Canada after years of steady payouts. More companies are holding or cutting dividends. We're back with John Zechner of J. Zechner Associates to tell us what's driving these changes and how should investors respond. Let's ask that first question, John. What's driving this? Where are they going?
Well, it's interesting more, Roger, on the investor side. What's probably surprised me this year, and I think I've underestimated a large degree, most of us maybe have, is how many income investors are out there that are in it purely for the income? And you get a lot of questions on this when you do, when the callers and all of that, they wonder about sustainability of dividends. And the reaction on stocks is surprising to some, because the old story used to be, dividends weren't really, everyone wants a decent dividend yield, but companies only pay you dividends if they're not generating a high ROE. The old story is if the company has an ROE, like a return on equity of 20 or 25%, why would they pay a dividend? Because you'd rather they take that money and reinvest it at a 25% rate than hand it to you. But that has sort of changed over time. As, growth has slowed down, the ROEs aren't as high, and companies want a bigger dividend because that attracts the investors. And maybe it's because of low, for zero interest rate environment we had for a number of years, everybody's looking for extra income, and if they want to get it from dividends. And what surprised me this year is how disappointing, how hard the stocks get hit when the dividends get cut or whatever. We saw it with BCE and all the rumors around, and when they finally did cut the dividend, was at running at 13% at the time. You cut it in half, it's still 6.5%. But at that point, that the bad news had been mostly in the stock and had come down a long way. TELUS did the same thing recently, and that someone rumored that they were going to start to cut the dividend or they couldn't grow it anymore. So I guess they came out and said, okay, we're not going to grow the dividend from here, but we're not cutting it. So maybe there's a bit of a sigh of relief, and the stock actually, bottomed out a little bit. But like I say, it surprised me how many people are in it strictly for the income as opposed to the growth. The biggest shocker one I saw out there was Northland Power, which surprised investors because they had about a 6.5% dividend yield, and then in the last month they cut it. The stock dropped 40% base, or close to 40%.
And you think it was all on that?
The yield was cut by 40%, and you realize, and I was on the management call with them, I listened to the story, and basically the reason they were cutting it, they just wanted more funds available to fund their growth because they're seeing so many growth projects with the U.S. pulling out of all renewables and everything like that. They see more potential to put this money to work, so they've got an 8-year projection of basically tripling their capacity of renewable power generation, and they needed more funds available for it, but rather than pay it out. But it just tells you there weren't as many growth investors as there were dividend investors. And I thought, okay, that's just, we got to recognize it in the market. Allied Properties was the same thing.
Is this a rebalancing maybe? Or, did we get used to it for a while because of what happened through the pandemic and everything, and now we're coming back to a more balanced approach?
I think it just tells you that people are in need of income. native yield, and they're not finding it anywhere else. And certainly with interest rates headed back down again, you're going to, a 2 and a 2.5%, long-term GIC. I mean, even a long-term bond in Canada is 380. It's gone up a little bit. People want, they want regular yield. And obviously, if you get it in dividends, you're getting it on, a tax preferential basis for individual investors too. So that's important. So, like I say, what is really has been an interesting study this year is how important that is. And the companies shouldn't take it lightly, and investors, I guess, have to pay attention to when, is there not enough free cash flow? Are companies paying out
that's the thing.
more
That's
than,
the dangers for the companies, too. They can get caught in this, right?
Well, absolutely.
Where they can't move forward.
Yeah, and they used to, for a while, a couple of years ago, Enbridge came under some pressure because you realize their dividend was more than actually their adjusted cash from operations. So I thought, okay, you're using capital to give it back to the shareholders. Doesn't really make a lot of sense as a business strategy, but if the shareholders are that dependent on it, and if they're all going to, basically get out of the stock, if you stop hitting that yield, they have to question a little bit, which is why, TELUS, I think their decision to maintain the dividend, maybe not grow it, sort of played that middle ground a little bit. We realize, people are counting on this yield. We're not going to cut it, but we're just not going to grow it until we get a little bit more free cash flow.
So as an investor, what do you do with that if you're seeing dividends start to be cut? Or held, but where do you go, or how do you balance out everything?
I think they've got to do a little more work, individual investors, and to read the reports, look at what the analysts are saying about what the cash generation is, the growth, and their ability to sustain those dividends over periods of time. I mean, the banks are a good example because they always have the thing they pay out around 40 to 50% of their earnings as dividends, and they sort of stick in that range. If it's suddenly, they're paying out 60 to 70%, you go, okay, why is that? That's not sustainable. The earnings aren't growing enough to sustain the dividend. So you have to look at what the strategy is, what the income generation is, what that growth is, and, what the yield is on the other side too. And it's, there a lot of question marks come up, especially you get to, income trusts and all of that, where you're paying out 80 to 90% of their cash generation as yield, whether it's a trust dividend or whatever. That's a trickier game because you've got no money to reinvest into the business and the company to sustain the growth, and especially if people want growing dividends.
Okay, we're going to have to pause on it there, but still ahead, we're wrapping up the year, so it's time to look at year-end tax planning. We'll unpack that with our next guest, and our phone lines will open up soon for first call, 1-855-326-6266. You can also email us, firstcall@bellmedia.ca. Shares of Lululemon are surging in pre-market trading, that after the Canadian apparel company posted profit and revenue in its latest quarter that topped estimates, driven by higher same-store sales and growth in international markets. Lulu also boosted its full-year revenue outlook and announced CEO Calvin McDonald is stepping down at the end of January. Some analysts see the move as positive, noting the company has been facing slow sales. Costco is out with its latest results, and the wholesale giant logged higher profit and also saw total revenue jump more than 8%, beating estimates. Same-store sales across Canada, the U.S., and international markets also came in higher than expected. Costco says the results were helped by a record-breaking Black Friday for its U.S. e-commerce unit. Shares of cannabis stocks are seeing a spike in pre-market trading, that after a report from the Washington Post that U.S. President Donald Trump is expected to push the government to drastically loosen federal restrictions on marijuana. According to the report, Trump plans to direct agencies to reclassify marijuana as a Schedule III drug, reducing it to the same level as some common prescription painkillers and other drugs. Trump's administration has been seeking to reclassify marijuana as a less dangerous drug for some time. And taking a look at the U.S. futures, Dow is up right now by 0.17%. The NASDAQ, though, being weighed down by Broadcom, Oracle. It's off by almost a half point. S&P 500, pretty much a wash right now. It is the end of the year, so there's a lot to unpack with year-end tax planning to hit a few deadlines by December 31st. Joining us now is Jamie Gollenbeck, tax and estate planning Managing Director at CIBC Private Wealth. Jamie, thanks as always for joining us.
My pleasure.
Okay, we've got about 2 weeks. What is it? A little over 2 weeks to go. What, if you're waiting, what should you be doing? What's the first thing you should be doing right now?
Well, we always talk about, the end of the year tax loss selling. You have a deadline of December 30th that settle that trade by December 31st. And you would do this, you have, the odd loser in the portfolio. You don't think it's going to bounce back. And you want to be able to use that capital loss against any other gains this year. But it's also your last kick at the can to go back 3 years. So you can take capital loss, apply it against capital gains in the prior 3 calendar years. And so 2022 falls off the table. So I would just take a quick peek at your 2022 tax return. If you reported any capital gains there, maybe now you want to realize that loser before the end of the year, take that loss, carry it back to 2022, and get back any capital gains tax paid in that year.
And how many do you sell? What do you base that decision on when you're looking at your loss at the investments that aren't doing well? Do you hold on to some, or how do you make that decision?
Yeah, so I think primarily you want to make sure it's an investment decision. In other words, you don't want the tax to drive it. At the same time, tax could be a consideration. So I'd look at your portfolio and say, these particular stocks, these positions, I think I'm done. I think I could better deploy these assets somewhere else in a different stock or a different position. I can rebalance the portfolio, time to take those losses. In terms of the quantity and quantum of those losses, then you really want to be strategic. Do I have other gains this year, in which case I can get the capital gains tax eliminated? Do I have gains in the prior 3 calendar years? Otherwise, you don't have to sell anything else because losses carry forward indefinitely. So there's no rush to sell things from a tax perspective if you can't use the loss right away. But at the end of the day, I would say make an investment decision first. That should be your primary consideration.
Okay.
Jamie, for some investors, you talk, for high net worth individuals, stuff like that, the idea of, personal holding corporations or things like that are better to hold investments. And what are you thinking as should it be as an individual, or are there any reasons to, put it in trust or do other forms that are, better defer the gains over a period of time or a better way to take in income as well?
Yeah, well, it's interesting. So there's a number of planning opportunities out there. I mean, the truth is that, if I was setting up a corporation today purely for investment, I probably wouldn't do it because actually investment income is taxed poorly in a corporation in all provinces. The tax rate is effectively higher. But most people, of course, have a business or they have a professional corporation. The money's already in a corporation, in which case it's expensive to take it out. So they do their investing in a corporation. There are some other strategies out there. People have used family trust, for example, on the high net worth side to do some income splitting. You've got to be careful. There's attribution rules there. One of the more popular techniques that we've been promoting over the last number of years with the decline in interest rates is to do what's called a prescribed rate loan, where let's say a parent loans funds to a family trust, charge the minimum 3% rate. Any rate of return above that can then be taxable out to the beneficiaries. Typically, these would be children and other family members. So there are some more sophisticated strategies out there involving family trust. But, for the average person, investing in a non-registered portfolio to the extent you use up all of your RSP and TFSA room is probably the way to go in a basic non-registered trading account.
All right, and let's talk a little bit about TFSAs. What's the best way to approach those if you've got some room or you might want some money from it?
Yeah, so again, one of the things we're telling people is between now and the end of the year, if you think that you need to tap into your TFSA for any reason, because TFSAs are a general purpose investment account that you can use for anything from a new car to a new roof or an emergency fund. The nice thing is that if you need money, let's say earlier next year, take it out this year. And the reason we suggest that is because you're allowed to recontribute any withdrawals beginning the following calendar year. So let's say you need to take $10,000 out in February for some reason. Take it out in December, because if you take it out in December, I'll have it for February. But then should you have some extra cash anytime in 2026, you'll be able to recontribute it immediately back to the TFSA. If on the other hand, you wait till February when you actually need the money and you take the $10,000 out, you're not allowed to recontribute that until the following calendar year, 2027.
I have another one, Jamie, more as a personal thing, because I turned 70 in January and I have to, roll out of my RSP. Do you suggest most people sort of go into a RIF the same way or annuities, or what are the options? Because I guess if you take it all out, it's all taxable at that point.
Well, that's right. So you have to convert your RSP by the end of the year that you turn 71. And you've got three options. Of course, you can cash it in and pay tax, which no one wants to do. I think rarely do people take that option. The most common option is the RIF. The RIF is a continuation of the RSP, but it's in reverse. A RIF requires you to take out a minimum amount, starting at around 5%, going all the way up to 20%, depending on your age, of the fair value every single year. There's also another option, a registered annuity. Some people do both. They want a guaranteed flow of income, so they'll put part of that money into a registered annuity. But I'd say most of our clients want the flexibility that comes with the RIF that allows them to choose the investments inside that account and then take out the minimum. Of course, you could take out more than the minimum, but the minimum amount every single year. And of course, you pay tax on that on an annual basis starting after age 71.
Okay, we're going to go the other way because I'm a young student, unlike John. And let's talk about what should we be aware of for the end of the year for students?
Yeah, so a couple of things. Students, we often recommend the RESP, the Registered Education Savings Plan. Parents want to make sure, grandparents, that are topping up $2,500 a year for every single student to get the Canada Education 20% match. That's $500 per year per child in RESP. But I would also say before the end of the year, if the students are already in post-secondary education, you might want to be strategic about RESP withdrawals. The withdrawals, other than the contributions, are taxable to the student. But remember, each student, each individual in Canada gets a basic personal amount, which is over $16,000. So this is an opportunity to withdraw $16,000 of educational assistance payments per student each year to soak up that basic tax credit. So if someone has no other source of income, they don't have a lot of income from either a summer job or a part-time job, in the next couple of weeks of the year, take a look at the student's projected 2025 income, see if there's an opportunity to take out extra money from the RESP that'll help pay for some of their post-secondary education expenses this year.
Okay, that's good advice. My son is starting college in January. Jamie, thank you for that last piece. All right, thank you very much for joining us, Jamie. We appreciate it.
My pleasure.
Jamie Goldenbeck is a tax and estate planning managing director at CIBC Private Wealth. Coming up, Rivian is making a high-stakes bet that its own AI chip will power driverless autonomy. We'll have more on that after this. And of course, our phone lines are open. John Zechner's taking your questions on North American large caps. Call us at 1-855-326-6266 or email firstcall@bellmedia.ca. Rivian is making a high-stakes bet that its own AI chip and a new LiDAR system will power its path to driverless autonomy. Bloomberg TV's Ed Ludlow reports.
Rivian's developed its own artificial intelligence chip for its future cars. That gamble might pave the way to fully autonomous driving. A lot of the tech world imagines a future where we don't own cars at all. We're talking about fleets of robo-taxis that are summoned through an app, maybe no steering wheel or driver controls at all. But Rivian's in the camp that does see people owning their own cars in the future and being willing to pay top dollar for a software platform that allows the car to drive itself. If this idea seems familiar, Tesla has been selling a version of it for years. Full self-driving supervised is not technically full autonomy if you read the fine print, but it can get you from point A to point B without needing to put your hands on the steering wheel. Rivian's path to autonomy is rooted in two big bets. The first, a custom AI chip developed in-house, which marks a big break from NVIDIA.
This is a RAP1 chip. It's a multi-chip module. In the middle is a Rivian-designed custom silicon surrounded by memory on two sides. The decision to build it in-house was based on a very rigorous analysis of the benefits we could come, and those benefits are velocity, or ability to get to market very quickly with it, performance, and cost.
The second, a major change in how Rivian vehicles see the world. The next generation Rivian R2 will have indented LiDAR sensors in it.
It's not just about the compute, it's also about the sensors, and it's about how they all come together.
This is Rivian Mark 1.
What the Gen 3 architecture does with compute levels that are dramatically expanded. So just to put some numbers to this, At the platform level, 1,600 sparse tops.
Right.
We can process 5 billion pixels per second, beautifully integrated LiDAR. That raises the ceiling to allow us to take your eyes off the road.
This will cause some debate. Tesla vehicles only use cameras as sensors for their systems, and what Elon Musk's company has always argued is that other sensors like LiDAR or radar are too expensive to scale. Until now, Rivian didn't really have an autonomous system. It had advanced driver assistance tools powered by cameras and radar. And Rivian used NVIDIA chips as the brain in the vehicle to interpret the world around it. Rivian says its new AI model will keep improving those older cars too, eventually adding capabilities like hands-off point-to-point driving. Rivian doing its own chip and ditching NVIDIA is a surprise.
On the Rivian processor side, this represents a significant cost savings to us. There is a lot of margin, of course, in the semiconductor space, and working directly with TSMC, we have a great relationship with them.
The new hardware is the unlock. It should allow Rivian to go from that driver assistance software in its existing lineup to true autonomy in the next Gen R2.
And the next big step is personal level 4. And what I mean is the vehicle can operate empty. It can operate without anyone in the driver's seat. It can pick your kids up from school. It can drop you at the airport. It's a complete shift in how we think about the vehicle experience.
Looking back, this was the company that pulled off the 6th largest IPO in US history, and it was first to market with full-size battery electric pickups and SUVs, beating out Tesla, Ford, and General Motors. But today, Rivian's struggling with the basics. Production of its EVs hasn't really scaled. Rivian's sole plant in Illinois is capable of building 250,000 units a year, but in 2025, it probably won't hit 50,000. The truest representation of that struggle, the stock is at a fraction of its peak. Right now in the world of tech, you have to have something to say about AI, and Rivian is diving deep into autonomy to appease its investors. An AI chip, LiDAR, and a large driving model. Right now, it's a promise from Rivian that their next generation vehicles will have genuine autonomous capabilities.
That was Bloomberg TV's Ed Ludlow. Coming up, we'll take a look at some notable analyst calls in Canadian retail, including an upgrade for Lululemon. Time to take a look now at some of the notable analyst calls and recommendations in Canadian retail. Now we're seeing a lot of movement for Lululemon this morning. Jefferies upgrading Lululemon to hold from underperform with a price target of 170 US, up from 120. Citi analyst Paul Lejuez raised the firm's price target on Lululemon to 210 from 190 and is keeping a neutral rating. And Piper Sandler raised the target on Lululemon to 190 from 165, maintaining a neutral rating. Elsewhere in Canadian retail, Wells Fargo Securities initiated coverage of Aritzia with a recommendation of equal weight. They set the price target at 110. And after Dollarama reported earnings and sales that topped estimates for the quarter, Scotiabank analyst John Zamparo raised the target on Dollarama from 220, from 205, maintaining a sector outperform. This new price target implies an 11% increase from last year, or from last price, Let's bring John back in, John Zechner of J. Zechner Associates, to talk about these. We've talked about Lululemon.
Yeah.
What about your thoughts on the other two, Aritzia? It's a tough industry, isn't it?
Well, it's not dissimilar to what we were talking about with Lululemon in terms of teenage market, having sort of the right products at the right time, having a good online presence, and they've certainly, since they've gone public, they've been hitting it out of the park on that, on those metrics. But the more interesting one was, the Dollarama, I find, because they, again, that bar is always set high for Dollarama. It's rated at 30+ multiple, and yet they continue to deliver. And it's, I think there's and we saw Costco reported as well last night. It's sort of similar. And what's clearly going on is the consumer is getting, way more price conscious, and they're going to places like this. They're shopping more at these stores, and Dollarama is sort of broadening their product offering. I mean, they were, Dollarama, the dollar store at one point, that they only did those items, and now clearly they have a different price points.
They're kind of like a mini department store.
They really are in a lot of ways, and what you've seen in the process is their margins have gone up, and they're expanding stores, they're getting more same-store sales growth, and they're improving their margins as well, which is why they continue to deliver this earnings growth, and the stock does well despite the fact that it's a very high multiple stock. I sort of wondered at a point too, how you're sourcing, especially with international, when trade barriers are going up and all of that, are your costs going to go up? But they seem to be able to offset it. And I guess it's almost like the Walmart thing. The bigger you get, the more powerful, but you have more purchasing power over some of your suppliers, and you can sort of drive that a little bit more. But I think it's the end. It's the pricing within the stores, it's the margins and everything. Just they've delivered.
All right, we'll leave it on that note there. When we come back, John will take your questions on First Call. All right, let's head to the phones for First Call. And David from Oakville, you're our first caller.
Hello, John. Question is about Baytex Energy. In the past, you've recommended it based really on its great valuation. I'm wondering if you still have it. Are you adding to your position? Looking at now, they have less debt because they sold the Eagle Ford, so that's a tailwind. But maybe headwinds is OPEC and the price of oil. Thank you. I'll hang up and listen to your response.
Right, yeah, thanks, David. You're right. I mean, of all the points, the sale of the Eagle Ford assets was a positive surprise. They got a very good price for her, better than expected, and they've taken that. And the worry of Baytex, why it was under pressure, because obviously they had a pretty high debt ratio, and as oil prices fell, they had less ability to pay that back, and that was a real worry because they have a higher cost of oil, especially with some of their heavy oil projects. So getting rid of Eagle Ford was good. They've got a better cash balance sheet now. Having said that, we've gotten out of the stock on this recent run-up because I thought, okay, well, where's your upside going from here? Because, you've got a better cash position. You're going to have to reinvest it somewhere. So, if oil prices recover a little bit from these levels, and I'm not optimistic it happens, you may get a bit of a further bounce in the stock on that basis. But, this is probably not a bad price to step aside. It's a different story. I'd be more inclined to get companies that have natural gas exposure. So I would take an ARC Resources or, a pay-to exploration or one of those over Baytex at this point rather than a pure oil play. If I was going to do an oil company, I'm more likely looking at someone like Cenovus or Whitecap, who have done sort of recent acquisitions of cheaper assets, which I think they can develop. Obviously, Cenovus ended up winning Meg Energy, and Whitecap bought the old Crescent Point and got those assets at a very good price.
Okay. Let's move on. We've got a few calls and some emails. Philip from Charlottetown.
John, I always respect what you say. I'm one of the dividend investors you were talking about earlier. What do you think of TELUS? I'd like to add to my position. What do you think?
Yeah, I'm pretty comfortable. I like the telecom space in general. TELUS is at a small premium to the rest of the group, but it's always maintained that. I think they've got an ability to monetize some of their assets as well over time. They're all selling towers and other infrastructure assets. But, I think TELUS can monetize TELUS Health at a point. So, I like that. They say the dividend yield is pretty high now, and they're not going to cut it. They've said that. They're just not going to grow it. So, fine with that. And, it's interesting, TELUS International, they bought back this year, which was, and that wasn't a great asset, but I sort of like the trade. They floated TELUS International out there a couple of years ago at $25 a share. It was a disaster in the public markets. Buy it back. The trader in me says, hey, you sold something at 25 and you bought it back at around 5. That's a pretty good trade. But it's not a great asset. So, they call it sort of TELUS Tech now, I guess. So they've got to absorb that in, and that took a little bit of cash. But I think, they'll start to generate free cash flow. You're seeing a little more general sort of calmness in the industry after Freedom Mobile came in with Quebec, or you got some pricing. Now you're seeing some problems now, competition. Now you're getting more pricing discipline. I think ARPU may start to turn around for all of them. So, I like all of the names, BCE, TELUS, Rogers in here. So, we're long all of them. right now. And TELUS we had gotten out of. I'm more likely to be a buyer of that one.
Okay. We've got a few emails we want to get to. The first one's from Fred. It says, good morning. Like your opinion on MDA space. Well, listen, thank you.
Yeah, we've been buying it again recently. We had lightened a little. I failed for quite a while. So it has had a tough year, obviously, with the EchoStar and then the rumors that they'd lose Globalstar as well, which would surprise me. I mean, this direct-to-satellite business is going to continue to grow. Apple, can be a big part of it, and Apple is the big player in Globalstar. So I don't know that they're going to walk away from that. And then beyond that, MDA Space, the arms dealer of the space race, and the Canadian company is going to get a lot of domestic business. What we saw from, the recent budget and the spending there, and they're expanding the backlog. Sure, there is a risk on Globalstar, but they still have the Telesat contract, which is huge, and they're prime on that, and they're picking up other business, and the valuation has come down dramatically. Yeah, no, I like it in here. So we've been adding into it in these low 20s range again.
Okay. I think we're going to wrap it up there a little early, but John, thank you as always.
You too.
I don't know if we're going to see you. Have a great holidays.
Yeah, same to you.
Some skiing in, all right?
Yeah, absolutely.
That is it for us here on The Street. Thank you to John Zechner of J. Zechner Associates for joining us today. Andy's up next with the Open, and the markets will open a little over 30 minutes from now. Have yourself a great weekend.